Good day, good morning, good evening, YouTube, Instagram, every other social media site out there. Thank you for joining us in the next installment of Everything Real Estate Investing. I am your host, Calvin Moore. Again, thank you for joining us next 20 minutes as we go over in this particular episode, market capitalization of a multi-unit property. As you recall, in our last episode, we walked through a multi-unit property, a two-family house, and we know that the most prevalent problem in that property was that of mold and mildew. We came up with a rehab budget of approximately $86,000. So what we need to do now is understand how much that property is going to be worth once it's all fixed up. Then, obviously, we'll be able to calculate probable capital gains once we sell the property. So stay tuned. Let's go over the numbers. Let's continue to crunch the numbers. Let's understand what market capitalization is. And thank you for joining us in this next episode of Everything Real Estate Investing. Okay, let's revisit the property really quick. Here's pictures of the home. And if you recall, here's pictures of the mold that was just in the basement. We're not even going to go into all of the mold that was upstairs in the bathrooms on both the first, second, and third floor. And then here's pictures of the back of the home where we need to see or have a new roof put in to help remediate in the problem of the mold buildup. Okay, so now let's quickly go over the numbers, those rehab numbers, the budget that we were talking about. If you recall in the last episode, these are our numbers for both the external. I won't go over everything. You could see it. I'm just going to quickly pan over what we're looking at, approximately our guesstimation for everything. And when we look at our pre-number plus our external number and internal number, we get a total of $86,700 that we're probably going to have to use or invest in that two-family property. Okay, so let's go over market capitalization, or what we call the cap rate. It's used to estimate the investor's potential return on investment, ROI, on an annual basis. So your cap rate obviously is different from your return on investment if we were just to flip a property. So as landlords, as people who are investing in 2 units and above, and we want to hold on to those properties for a significant amount of time, well, maybe not significant, but definitely more than a year, that's when we start to use our cap rate in order to understand what our return on investment is basically given to you in an interest or a percentage form. So let's go over actually what the cap rate looks like. So in order to solve, for lack of a better term, for the cap rate, for market capitalization, what you do is you divide your current market value or your acquisition cost of the property into your net operating income. Now, I know we didn't go over net operating income and how we solve for that, so I'm going to do that very quickly. Okay, so this is how we solve, or how we come up with our net operating income. Simply take our annual rent roll, which we already know is $50,400. Okay, We take our annual expenses, which are comprised of our taxes, which for that property equal $14,654. We take our maintenance, which will not be a lot because remember, we just finished rehabbing the property, but let's just say it's going to be $3,500 a month. We take our water, $850, a year. Maintenance, $3,500 a year. Our water, $850 a year. And our insurance, $2,250 a year. We add all of those up and we get $21,254 a year in which we are spending on our annual expenses. So what we then do to solve for, again, our net operating income, we take our annual rent roll, $50,400. We subtract out our annual expenses of the $21,254, and we get $29,146 a year that we are making as far as our net operating income, our NOI. Now, in order to solve for our cap rate, it's very simple. Like I said, we take our $29,146, that is our, again, net operating income. We divide that into our acquisition cost. If you recall, we purchased the property for $300,000. We put $85,000 into it, so $385,000 out of our pockets. When we do that simple equation, that simple math, we get 0.0757. But remember, when we are changing it into a percentage form, we multiply that number by 100 and we get 7.57%. So that is our cap rate for that property that we spent $385,000 for, and we are making $50,400 a year in gross income. We bring it down to our net income, and again, we get a cap rate of 7.57%. Okay, so you're probably asking, well, what does that 7.57% mean, Cal? It means, very simple. This is what it means. If you had $385,000 and you put it in the bank into a savings account, you get less than 1% interest on it, right? Okay. If you bought some T-bills in the marketplace, $385,000 worth of T-bills, you might get 2%, 3%. Bank CDs, 1.5%. 1.7%. If you choose a good stock that pays you an excellent dividend, you could get 3%, 4%, 5%, maybe up to 7%. Okay? But investing in real estate, putting that $385,000 in real estate, your cap rate, or what you will be making a year off of that particular investment, is 7.57%. So that's what we mean by cap rate. Now let's just figure out the differences between our cap rate and the amount of money we will be making on that type of investment versus us just flipping the investment. Okay, so I know I'm hitting you guys with a lot of different theory, equations, and stuff like that. Hopefully it's simple to you and I'm not confusing you. But now let's go over how that market cap rate transfers or translates into what the property is worth. So, as we know that cap rate for us is 7.57%. That's our cap rate. But remember, we acquired a messed up property, we fixed it, we put a lot of money into it. So now we want to either decide basically one or two things. Do we hold it and make that 7.57% a year on our $385,000 investment, or do we sell it? Now, this is how we translate that cap rate into what our selling price is going to be. Remember, our cap rate is 7.57%, okay? What we want to do, we want to sell the property at that 7.57% or below to a new investor. And the further below we get under that 7.57%, the more money we make. So let me put it into perspective really quick before I show it to you on paper. If we say to an investor, a potential buyer of the property from us, hey, listen, how would you like to make 5% on your money, on your capital? And they say, yeah, you know something, Cal? I only make, 1.5% less than on my CDs, or less than 1% in my savings account at the bank. Of course, I would love to make 5%. What do you got? What are you trying to sell me? Well, I have a property for you to buy that if you purchase it, you will make 5% return on your money. How will I do that, Cal? And what is the price of the property? So now what we're going to do is to take a cap rate for him of 5% a year, divide that into our what? Do you guys know? Do you know? Divide it into our net operating income, and that will give us the selling price of our property to him, whereas he is making 5% a year on his money. Let me show you what I mean. Okay, so let's talk about holding the property versus flipping the property. With holding the property, we have our $385,000 investment, which makes $29,146 a year. That is 7.57%. Now, when we look at the opposite, to flip the property, we take that same $385,000 investment. Let's just say we're going to sell the property to a new buyer, giving them a 6% cap rate, which is better for them. I know earlier I said we would do 5%, but let's just do 6%. That equals a sales price of $766. Let me show you how we get that. What we do is we take the $29,146 for our net operating income, and we divide it by 0.06, and we get a sales price of $485,766. Now let's look at the profit. We basically have a $100,000 profit. Now, to figure out ROI, our return on investment, we simply take $100,000, our profit, divide it into $385,000, what we invested into the property, and we get 0.2597. Multiply that by 100, and we get a return on investment of 25.97%. Okay, so just to provide us with a quick recap of the decision that we can make with regard to that two-unit multifamily house. We can either, one, hold the property and make 7.57% a year, or $29,146, or we could flip the property. Sell it for $485,766 and basically make a return on investment of 25.97%. So as you can see, there's decisions to be made. What would be good for us as an investor? Do we want that passive income every month that again equals our cap rate of 7.5% a year? Or do we want to sell the property right away in order to make that basically that 26%? So that's how we use market capitalization, and I hope that made sense. Did it make sense? Hey everybody, how's everybody doing? I hope you really enjoyed what we just went over as it pertains to market cap. I have basically 3 great things to tell you. 1, we're going to keep our eye on that property. Okay, we're going to do a little bit more due diligence before we put in an offer, but we're going to keep our eye on it, and I will keep you guys abreast. That's number 1. Number 2, I have an excellent episode in store for our next go around. We are going to go over sales. Due to the fact that as investors, people who fix and flip, what do? We find properties, we fix them, and we sell them. So since we're talking about everything real estate investing, we have to talk about finding properties, which we've gone over. We have to talk about fixing properties, which we've gone over. And now we have to talk about selling properties, which we haven't gone over yet, but that's for the next episode. And number 3, can you hear it? Can you hear it? Ding, 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 ding. That's right, I'm letting you guys out early, just like in school. I mean, right now, here in New Jersey, it's a snow day, so we are getting out early. I'm letting you guys go early so I can go and do what I need to do. But again, I am looking so forward to next week. And until then, I want you to have an excellent and happy real estate investor.